All right, everybody, welcome to another episode of the Prop Tech Genius Show. And here you are, Andrew. You are a genius. You get to be called a genius for today.
Awesome. And I thought I'd have to go work for Apple to get that.
I know, but you don't. You come on my show and you're a genius. It's awesome sauce. Well, I'm so excited because we actually have a VC guy in the house. Woo woo! My very first one, I was telling him, you're the very first one. And so we get to have a really cool conversation around what founders should expect as far as what's going on with VCs now and kind of what you're looking for. And it's going to be really cool because I think this is timely for sure. Like we have a lot of founders in our group and they're looking for money, and this is always a good conversation to have, what they should truly expect on what they need to do and all those great things. So it's awesome. It's
Awesome.
very
Thanks
cool.
for having me.
Yeah. So I'll let you introduce yourself, tell your bio, kind of what you've been doing, and then we'll kind of get into the meat of it. So take it away.
You got it. I remember ages ago, of all things, during a presidential debate, a guy had chosen as vice president candidate. No one knew who he was. So, like, when it was his turn to speak, he just comes up and says, "You're all wondering who I am and why I'm here." And that's how I approach the bio part of all
Oh,
of these
Bart. Oh,
things.
yeah. Okay.
My name's Andrew Ackerman, and the reason what I'm about to say might actually be interesting and maybe even insightful and worth listening to outside of all the noise and self-proclaimed geniuses out there is I've been doing this for over 15 years. So I started off, I was a consultant for many years, but then I did my first startup a long time ago.
Mhm.
Exited that after a bunch of years, worked at a family office, then did a second startup that was a quicker exit.
Mhm.
Was also a bit more of a salvage ops. And I learned a lot from that. Shockingly, you learn a lot more from the crashes than you learn from the good landings. But there's an old saying, experience is what you get when you didn't get what you wanted. So my second startup was quite an experience. And then after that, I started, or actually during that, I started investing in startups.
Mhm.
First as an angel investor, and I got lucky. Wasn't particularly good at it. I just got lucky the first couple of times. And
Mhm.
then more systematically, when I joined Dream Adventures to run initially their New York office, like a generalist program, all pre-revenue. And then as we evolved Dream It, ultimately launching the prop tech and the construction tech vertical in 2017 and being more systematic and more thematic about how I invested.
Very, very cool. So, I'm a founder. So let's do this. I'm a founder. I'm looking for money.
Mhm.
So if you were to have a conversation, which I've been in several conversations
Yeah,
with VCs, and I started last year, which that was like a train wreck for me, right? And
yep,
it was
usually is.
interesting. It seemed like all the normal things kind of weren't normal last year. Like an angel investor was really kind of like a seed early stage VC investor. And I was like, but angel is like, you have an idea and like, we
Mhm.
think it's cool and we'll give you money for it. But no. They wanted you to have revenue. I was like, what are you talking about, Willis? I'm like, I don't understand that. So and then every VC I talked to is you're too early, you're too early, you're too early. That's like the running theme last year was you're too
Mhm.
early. So so how do we
So
approach it now? I'm just
there's
curious.
like four questions embedded in that, and we'll try to get to all of them at once. One of them is, how do you know which VCs or investors to approach? The other is how do you approach them well, hopefully
Mm,
avoiding the absolute snafus. Number three is what's going on in this stage in the cycle that makes it maybe different than a year ago or hopefully a year from now. And then last but not least, what do all these terms really mean? Is there any consistency behind them? And what does that imply for who you should approach? I
mm.
think those are the four questions. But I used to be an ex-consultant, so
Yeah,
I talk
man,
in
you're
bullet
awesome at
points.
that. Yeah, go.
So let's start with how do you know who to approach, right? So there is there are very few things that really annoy investors more than getting random outreach from startups that if they just read the first two lines of the LinkedIn profile would know they shouldn't be contacting them. Right? It means that you have done zero homework. And what that tells me is um, not you personally, the generic you
Oh,
are, oh,
thanks.
no, I'm just kidding.
Yeah.
It means
No,
that you
but just
are,
go to PitchBook, and PitchBook says these are early stage people,
well,
and
so,
we think
so
we're early
let's,
stage,
yeah,
right?
let's take that step by step, right?
All
So,
right.
like the consultant, I got my summary slide with the 4 bullet points.
Okay.
Now
All
we're
right.
gonna have
Keep
one
going.
slide each for, each of those 4 points. So, yeah, there's the totally clueless founder who just, oh, you're an early stage investor, boom, I'm gonna send you something.
Yes.
Uh, so that is wrong, right? So I may be an early stage investor, but I invest in prop tech and construction tech now. And I'm starting to do other stuff. That's not out there public, but like you wouldn't know that.
Mm-hmm.
But if you took about 5 seconds to go to my LinkedIn profile and read what it says, you would know that I haven't invested in, say, ed tech for over 5 years, over 6 years,
Mm-hmm.
actually. But I still get pitches for ed tech because someone got me on a list of ed tech investors. So, and at least they did a little bit of homework and they found out that I did do ed tech at one time, or maybe they saw that I was invested in an ed tech startup. So they reached out to me and I just politely say, hey, I haven't done ed tech investing in 6 years. Best of luck. But they did a little bit of homework. There are other ones that come out to me and says, oh, I love what you're working on. I think you should back. And then they'll pitch me on like, I don't know, like uh, green eggs and ham or something that's totally, I've never invested in anything even remotely like that. And what that tells me is like sentence number one, I just lied to you. I did no
Yeah.
research. I don't know what you're working on.
Yeah.
I'm just going to throw the same BS, form letter at you. And
Mm-hmm.
I'll tell you why that bothers us so much, right? Like a little bit of behind the kimono. So there's two things. Number one, we're super busy and you just wasted our time. Uh,
Mm-hmm.
okay, that happens. Some of us are kind of resigned to the fact that our email and everything else is going to be overflowing. So that's an annoyance.
Mm-hmm.
But what really gets us, the deeper thing is you've just telegraphed to us that you don't do your homework.
Uh, yeah.
Right? So would you just call up random companies and say, hey, you should use my software, even though you have nothing to do with it? Like, let's say you're doing productivity software for real estate agents. Right, I'm
Mm-hmm.
working right now. One of the things I've been doing since Stream It, I've been working with a fund called Second Century Ventures. They're the VC arm of the National Association of Realtors. They're super interested in software that makes the broker better, saves
Mm-hmm.
them time, pain,
Mm-hmm.
just keeps them central to the transaction. So in theory, if that's what you're working on, you should absolutely reach out, to someone like me or realtor associations because they can get you a lot of introduction to potential customers. But let's say you were doing something totally different. Let's say you were doing, um, office management tools for doctors. Would you go out there and call up a real estate brokerage and say, hey, you should use my tools?
No.
But I'm not a doctor. So when you as a founder reach out to a VC and you haven't done the basic research to show that you understand what I invest in,
Mm-hmm.
what I wonder is how are you going to sell? Right? And it implies that you were a bad salesperson.
Well, but it also implies that the person that's keeping their, like, LinkedIn profiles don't get updated. Like,
Well,
it's
but
sometimes,
mine is, right?
well,
If
I know
mine,
yours is,
yeah.
but sometimes they don't update them a lot. And so that's kind of a, for us founder people, we're guessing.
Yeah. Well, no,
We're throwing stuff up on the wall and see what sticks. I mean,
here's where I
basically.
toss you a bone, right?
Okay.
Um, Lately I've been looking at more, this is totally different for me, consumer focused blockchain kind of under the hood type startups. But I
Yeah.
don't have any of that on my LinkedIn profile.
Mm-hmm.
I'm still exploring that. So if
Mm-hmm.
you were a prop tech company and came to me and I kind of made that change, then I wouldn't be annoyed. Like you did your homework. That's what I told the world I do.
Mm-hmm.
Well, you're totally okay with that. That's fine. And if
Yeah.
I were, I think most VCs actually do keep their profile pretty up to date. But let's say
Oh,
I was
yeah.
one of those guys that didn't, and you reached out to me, and it was what was on my LinkedIn profile. If I were fair, and most of us are pretty fair, would say, okay, I get it, Amy, right? You reached out to me because of the persona I put out to the world. That was a totally reasonable thing to do.
Okay.
Now, I'm not mad at you. I'm not annoyed. I just don't do that anymore. I know it's not your fault. There was no way you could have known.
Mm.
My comments are when it's blatantly obvious. Like if you look at my LinkedIn profile, it says prop tech, construction tech right there, right? It's I don't make it hard. So that's why we know that you've done zero homework, which worries us about your ability to perform it in the startup. Okay,
Ah.
so that was more than a few slides on topic number one.
Okay. All right
So
then.
let's go to question number two in no
Mhm.
particular order.
Mhm.
Um, what does it mean? I'm an angel, I'm a VC. What does that mean for what I'm looking for? So traditionally, an angel would be interested to get involved much earlier than a VC, and they would have a higher appetite for pre-seed, pre-revenue companies in particular, maybe even a company that's the product's not totally done. And these are still broadly true, right? There are VC funds that like to get in super early, and there are angels that like to be a little later. They're still broadly true, but they're only broadly true, right? There's a lot of noise in the signal.
Yeah.
And in different phases in the economic cycle, everyone moves up and down a half step. So right now we're in a tough fundraising environment. Uh, Listen, I never say fundraising is easy. There's no fun in fundraising. It's always hard and painful. Right? Occasionally you get super lucky, and then we all hate you a little bit. But it's always hard. Even if you're a normally great team with a normally great startup, it's not.
Hmm. Yeah.
Uh, but in like say 2021, market was pretty frothy. Right? You had a lot of people coming into the space, first time investors. There was a lot of money coming in. So it was easier than it normally is.
Mm.
And when things are easier than they normally are, there's more competition, there's more supply of money than demand for it. That's not strictly true, but at least the investors are, you know, somewhat chasing deals, and the good deals close quickly.
Hmm.
They're willing to loosen their requirements. And what that means is if I normally want, $1 million ARR to consider a Series A, if the deals are getting snapped up, I might go a little earlier. I
Mm.
might say, you know what, I'll look at companies that are doing $500,000 of annual recurring revenue. Because otherwise, if I wait for them to get to one, someone else will have invested and I'll miss it.
Mm.
And the angels at that point who would normally like the product, to be done, even if it hasn't sold anything, they might say, you know what, I want to look at it. They're almost done, or they're three-quarters of the way done.
Hmm.
And wherever you are normally, you move a little, earlier because the market's hot. And when the market is colder, as it is now, you can tighten up your lending requirements, where the banks do. You can
Hmm.
say, yeah, I normally want $1 million for a Series A, but right now there's not a lot of people competing for deals for me. I don't want 2 million. I'm an
Yeah.
angel. I normally invest pre-revenue, but I'm seeing so many good deals, and I only have so much money. So let's look for sums that have a little bit of revenue, right? That's a little less risky for me. I can get that now, where before, a seed stage VC would be snapping them up.
Hmm.
Now there's less competition. So it all slides a little to the left or to the right, depending on what the overall temperature of the market is.
Yeah.
So that's what you were seeing, Amy,
Hmm.
on that second part.
Yeah.
Okay, let me see if I can go back and remember the other two bullets there. Um, about what we're looking for, what approach. God damn it, I can't remember the other two bullets. That's why I should write it down. But there are definitely two other things in there, and they'll come back to us as we talk.
Oh, so how do I know well, we talked about how we know we're approaching the right one. We talked
Yeah.
about the environment that I was kind of facing.
Mhm.
And then man, I have a cold, so I don't
No
remember anything
worries.
either. I'm
So,
like excited about
there's one other. Let's go on this. It's not really a tangent so much as a jumping off point.
there you go.
Um, so related to this concept of like when the market is hotter or colder, the appetite and the goalposts are different. So part of it is just driven by, hey, there's not that much competition out there. I'm going to demand that the startups be further along. There's also underlying dynamics with the customer set. So let me take an example. Like in the real estate world, particularly in the commercial real estate world, or multifamily too, uh, things are not as hot as they used to be. So if you're a B2B focused startup where you're selling, say, enterprise software to these large clients, that's a longer sale to begin with, right? You could be looking at a 6 to 9 month sales cycle. So let's say you raise a little money, and money you usually end up getting about 18 months of cash at a time, maybe a little more, maybe a little less. That seems to be about right. But what really that means is you want to hit your numbers by about month 12 because it can take you 3 to 6 months to raise your next round. So you got about 12 months to really put some wins on the board on the revenue side. But a company that you start approaching right the moment after you've raised, it's going to be minimum 6 months before you start seeing revenue from that,
Mm-hmm.
and maybe closer to 9.
Mm-hmm.
And that shifts back and forth depending on the economic cycle as well. So a lot of the customers right now are either hurting a little bit or uncertain. And when they hurt or when they're uncertain, budgets get tighter. And it's nothing to a large real estate company to say, yeah, right now we're not sure how the earnings are going to come out, so we're going to put this on hold for a quarter. Quarter for a large company like Brookfield, that's a blink of an eye.
Mm-hmm.
Right? Nothing's happened in a quarter as far as they're concerned. That's like massively important. I shouldn't say that, but a quarter isn't making or breaking the company in any way, shape, or form. But to a startup, a quarter is like a decade,
Yeah.
right? That's a lot of time. And when you were thinking like it's 6 to 9 months, now it's going to be 9 to 12 months. I don't
Yeah.
really have any margin for error anymore on closing those deals. So we have a lot of the B2B focused companies that were on target and now everything's been pushed out except for their runway. So they're getting to a point or they've gotten to a point where, um, there's still a good business in there somewhere. It's going to take a
Mhm.
little longer to get to. And they don't have money. So they need to raise money, having not hit their marks. So insiders will sometimes float them a little bit more. But if they were originally funded by, say, angels or small seed funds, those guys are tapped out. They don't have a lot of money to come to the rescue
Yeah.
for a company that's like, we just need another couple of months to get to the Series A.
Mhm.
And outsiders are generally not willing to come in for something small like that. So if they're really good companies, they can raise around. It may be flat, it might be down. It certainly won't be as rich as they'd hoped. Uh, but sometimes they just got nothing and they need to slash and just hope they can get through.
Right.
Then there's kind of a catch 22. They slash, but that means they can't grow as fast.
Yeah.
So there is a danger of a death spiral in that case. Now, those are particularly B2B companies. In the B2C world, the dynamics might be different, right? If I'm buying or selling a home, there's certain things I need once I buy or sell a home. Now, I might delay a little bit, I might not, but those are more likely to be on the margin, right? If I'm selling to again, let's say Brookfield, right? And it's a $30,000 contract or $50,000 contract. Not getting that one customer in can have a meaningful impact. If I'm
Mhm.
talking about, I sell and I'm making $1,000 per homeowner, and they're 30 instead of 30 of them, I get 25. It's a little less painful.
Sure. For sure. So, so the number of prop tech companies that have failed recently, there's been like a number of them. Does that concern you investing in prop tech companies going in the future?
I mean, the difference between being concerned and being worried is whether my companies or not. Uh, I'm not concerned. I've been doing this for a long time, right?
Okay.
I was going to give you the number, but then I just feel old. Uh, markets go,
All the same.
markets get hot, markets get cold. It's like the tide coming in and out.
Mm-hmm.
It's inevitable that when the tide goes out, it leaves some like driftwood and all that behind. The truth
Yes.
is, some companies got funded that really were on the margin and shouldn't have,
Mm.
weren't that good. There's also companies that, it seemed totally good. The only way to know is really the one you had irreducible risks that you just couldn't resolve other than by trying. You tried it and didn't work out, right? They will, and startups will fail.
Yeah.
Like I'm in this weird industry where if a third of my investments go to zero within 2 years, I'm doing awesome.
Yes.
That's not like the real world.
No.
So I know it's going to happen.
Yeah.
And sometimes it happens a little faster, sometimes it happens a little worse. I had one company, um, awesome founder, perhaps had multiple exits, like big play, like big 5, 6 figure sales, but enterprise sales, like to large customers, like hit in exactly the situation, we're talking about. And
Mhm.
he was at that point where on the cusp of being cash flow positive, right? Once you're cash flow positive, you go from needing money to wanting money. That
Mm.
is insanely liberating because when you want money
Yeah.
and you don't get it, you're
Mhm.
okay. You just grow slower,
Yeah.
right? And if you're in an environment where like everybody needs or wants money and no one's getting it, that's okay. If you need the money, you're dead. So
Yeah.
he was like right on the cusp of that, and all this went down. I was worried for a little bit, was he going to get the little bit of money he needed to like just get over the hump? And
Mm.
thankfully, it looks like that's happening. But the real tragic part of this part of the cycle is when a single quotes good company, one that should make it, just for whatever reason, isn't able to raise that last little bit they need to get over the hump, just
Mm.
because of external. They get kind of dragged down by the overall sentiments. And
Right.
that happens, and that's the tragic part. But listen, it sucks if you're a founder and your company goes under. I don't mean to sound not sympathetic, but that's what we're signing up for, right? We're signing up for the kind of things that make our friends and neighbors like quail inside. Like, what? Like they will never do that.
Yes,
That's
that's true.
not the way they're willing to live.
Right.
And we are, because we want that payoff.
Mhm.
So,
You're a special breed. That is definitely for sure.
oh yeah,
Is
we're insane. We
Yeah,
are.
crazy.
But anyway, that's so to answer your question. Yeah, there's more than normal, and most of them go out with a whimper, right? You never see them; they don't implode massively.
Mhm.
Um, but that happens all the time. It's really a matter of extent.
Yeah, there's some that I was looking at it and I was like, you actually sold somebody this business model and they gave you money? Like, really? I was
Yeah,
like, just give that to me because mine's gonna work. Like, seriously? What the hell? I was just kind of looking at it, I was like, what? What?
yeah. I'm not
You
gonna lie
know?
to you. Like I had a
Yeah.
conversation yesterday, last night, with a friend. He was up from DC, and he asked me about a specific company. He's like, "Oh, did you ever look at so and so?" And he had like in this neutral like expression on his face. And there's one or two reasons why he's asking that. Either
Mm.
they're killing it or they're about to die. And there's a fairly good chance it's in his portfolio.
Yeah.
So I thought the founder was kind of a dick. And I thought the product was kind of mediocre, but I hadn't looked at it in like four
Yeah.
years, 3 years. So
Mm.
I said, yeah, I remember looking at him a couple of years back. It was a pass for me. It turned out it wasn't his portfolio, and they're looking to sell.
Mm.
By the way, for reference, for those of you who are tuning in, like, and it's 2027, this was recorded in April of 2024, just so you understand the context that we're in.
Oh, good idea. Good
Yeah.
idea.
Um, so yeah, and he's like, yeah, they're looking for an exit. And it turned out that like the founder wasn't very coachable, which was part of the reason it was getting difficult.
Oh, shocker.
But yeah, I mean, there's an expression like a recession is when your neighbor loses their job, and a depression is when you lose your job. Uh,
Yes.
so yeah, that was, I felt for him, and I just needed to be sensitive to it.
Mm.
I don't know where that came up. I don't remember you
I don't
asking the
know.
question.
Yeah, no, so why are you choosing to be in prop tech and contact at the moment? Like, why did
So
you choose this vertical?
yeah, let me take you through a little bit of the historics, right? My when and how we got in. Um, so when I was at Dream, we had been looking at real estate technology for a while. We had gotten into different verticals over time, and as a company, we tended to sort of fall into the verticals, sort of by accident.
Mm.
Right? So Dream, it was at one point very well known for its health tech practice. Turned out that a high school buddy of mine, who I also went to college with, had just started like a program of his own down in Philly. He ran into the Dream It guys, they folded it in, and Dream It Health was born. And it did really, really well for a decade. Um, yeah, about a decade. Then we would transition to like a later stage model, and one of the founders of Dream It happened to be very interested in ed tech, and had developed contacts at Penn State, which is, if you know ed tech at all, Penn State and Arizona State were at the time like the two of the top leading schools when it came to distance learning and innovation and education in general. Penn State threw a chunk of money at us. So they looked around the room and they said, Andrew, you're going to go spend that up. Okay, fine. But we had kind of fallen into it. But in contrast, we'd been looking at prop tech for a while. And then we were introduced to a gentleman, most of this is public, so I'll keep it a little vague, but who, among many other things, happened to be developing a very large chunk of the city to the point where it was transforming the city. So as we were talking to him about what he was interested in, how he wanted to help that city, it kind of dawned on us that, wow, you're dealing with a lot of general contractors and a lot of property managers and a lot of real estate agents. That's a whole bunch of potential customers for a program that might be focused around prop tech and construction tech. So we got in about 2017,
Oh,
which no one was really thinking about prop tech at that point. But we kind of we ran the numbers, and it looked like the amount of activity in prop tech and construction tech. I mean, prop tech was like this, construction tech was that compared to it. But the amount of activity in 2016 was roughly analogous to where health tech was back in 2012 before we went in. And health tech was poised and took off. So he figured one of two things is going to happen. Like we're getting in at just the right time, or we'll just be there and we made the totally wrong choice and it's nothing. And we'll quietly kill it later. But we had a pretty good qualitative feel that we were at a turning point, and we were right. And so the next couple of years, we went from conferences where it was like 20 of us in a room to like 4 of us speaking to 400 people in a room. And it was only 2 or 3 years later that it really took off like that.
yeah.
So we managed to get in early at just the right turning point. I had one guy say, he's like, "Oh, where were you? And where were all these guys when it was just 20 of us in the room?" And I turned to him, I said, "Man, that's the nicest thing you said to me, because I got in at the very last moment to be considered old guard. I mean, you guys were OG."
Yeah.
But that's it. It was a little bit of luck, a little bit of analysis, and it's been really good for us for a long time. When 2020 hit, Dream had decided to get out. And my analysis, I respectfully disagreed with him on it. I said, listen, it's tough to be in commercial real estate right now. When everyone's saying the office is dead, I don't think it's strictly true. I don't think it's going to play out quite that way. And I had reasons behind that thesis. And I said, no one's investing in that area. Like we can make it go. We get the best startups in. If they have the right combination of like runway and product.
Yeah.
And even if we don't, like single family, like buying houses out in the burbs. Remember 2020, 2021? Smoking. Construction tech had just started to take off. Like GCs, they got religion about technology, and that had started to take off. And even multifamily, in some of the blue cities, it sucked, right? And New York in particular has basically shot itself so hard in the foot that in 10 years, we're going to have no affordable housing that's, not basically a war zone collapsed pile of rubble.
Right.
But in red cities, multifamily was doing pretty good. So I kept going. I kept doing some of my own investments on the side. I invested in Dream It alumni companies that I'd been tracking for a while, and knock wood, they're doing very, very well. The market as a whole continued to do very well for the next year and a half, 2 years, and then it kind of soured. I think it'll be back, right? I think it's a natural correction. I think it's driven partly by the underlying customer base, but then also to a large degree, there was a whole bunch of people that jumped in thinking it was awesome, didn't really know what they were doing. They got their butts handed to themselves, and then they stepped back out. I think we're going to come back. It's going to be more healthy going forward, which doesn't help you if you're a startup with 6 months of runway. Sorry, but that's where I think the rest of the industry is going.
No, for sure. And I think we're in this quagmire for a little bit, right? I mean, the Fed just recognized that the inflation was still higher than it wanted to be. And so that's going to delay their interest rate cuts. And real estate isn't the most sensitive to inflate, interest rates. So you
Yeah,
know, we're going to be stuck in this for a little bit, but I'm doing cartwheels because it's forcing real estate operators to actually look at their operations and get efficient. And
yeah.
that's,
There's two sides to every coin on this one.
yeah, yeah, for sure. And that's some of the stuff that I've been preaching for, I don't know, I've been since I got in real estate in '08. Like it's like, come on, y'all. This is like the most inefficient. Y'all throw money on the street and you're like, who cares?
Yeah,
Yeah.
I hear you.
What the heck? So yeah, so it'll be nice. And I think all the ESG mandates that are coming out, that's going to drive a lot of the tech going forward. Colorado mandated
Yeah,
it. They
so
have to get
let's
net
why
zero.
don't why don't we go into that? I feel like the S and the G has kind of fallen by the wayside
I
now.
know, I know. It's
And
just
top
E.
six, in the real estate market, eh, there are large pockets of the real estate world that are not particularly progressive.
Hmm.
Uh, sometimes they'll pay lip service to it, but it's not really in their heart of heart. However, the E in ESG continues to be strong because there are mandates in a lot of cities, and just in general, when we're in a rising or uncertain energy cost environment, when they build, will haunt them all the way through. And that's actually an interesting point. One of the reasons this market is so interesting, which is kind of a euphemism for effed up, is the way the different players are disconnected.
Yeah.
Right. So the general contractor who builds the building
Yep.
really gains very little, nothing directly from making the building more energy efficient. That the total cost of ownership of a building is borne by the ultimate owner. And so it's not the general contractor who often has most of the expertise around what they can put in there. Right. So
Mhm.
they know the most, but are motivated the least. The developer, if they're going to own it, okay, they're fully motivated. A lot of times the developer is like they build it and they sell it.
Mhm.
So total cost of ownership is not top of their mind. Right?
Right.
They're a little closer to it because, if they're Energy Star rated, if they're like lead platinum and they can kind of get more for it, or the owners can get more rent for it, which means they're willing to pay more for it from a developer. But it's really a fragmented value chain.
Mhm.
Um, it's not like, say, manufacturing where you got one guy who owns the plant, buys everything that comes in, gets all the money from everything that goes out, and everybody in the plant works for them.
Right.
In the prop tech and construction world, you've got general contractor, and 80% of the people that work for the general contractors are not part of their company. They're subcontractors, right? You got the developer, you got the owner, you got the architect.
Mhm.
They're all different players, all different incentives. So it makes our world kind of interesting to navigate.
For sure. I think that you could solve that problem if the developer had an exit strategy with an owner and the owner was truly mandating what that developer built. And then,
There's
but
still a
that
disconnect.
it doesn't happen that way for sure. Yeah.
If they're
Yeah.
the same player, and sometimes you have total vertical integration where people build
Yeah.
their own.
Yeah.
And
For sure.
sometimes you get the architects and the general contractors being the same entity if they're a design build firm. So to
Hmm.
the extent that you can get, to the extent that one player is wearing two or more hats, it gets a little better. And they
Yeah.
tend to be the ones that adopt the technology a little faster
Yep.
because the incentives tend to be in line. So instead of it being separate companies that have
Sure.
different incentives, it's just separate departments within a company,
Yeah.
which is a little bit more manageable.
Yeah. I don't know, my background, but I'm an old GC and I was a developer before that. After that, I was a GC
Yeah.
and became a real estate developer. Then I became a tech person. So yeah, I did all of those. So I totally get where you're coming from for sure. I mean, it's an interesting game and everybody's trying to cut costs at every turn because that affects their margins. And so if you're looking at it holistically, it's
Yeah.
like, okay, whatever the architect draws is basically what's going to get built. And who's going to mandate what the architect draws? It's either the
Yeah.
developer or the owner.
Well, once the architect draws it, and then you kind of cut that up and you send it out to the here the GC. The GC chops that up and sends it out to the different subs.
Mhm.
There's a whole process of back and forth,
Yep.
but it's difficult to track, and it's not clear that they're optimizing for the same thing that an owner would want.
No.
Um, but I just remembered one of the other points that you raised.
Oh, look at that. We
Yeah.
did good. All right, go.
It's like you keep being told, like, come back when you have more traction, when you have more.
Oh, hey, yes. All right, good. I'm
So
so
I'm sure
glad you
you've heard
remembered.
this, and I'm sure a lot of your audience, the VC soft no. So for those of you in the audience that don't know what that means, VCs hate actually saying no. I'm not going to invest in your company. So a good chunk of the time when they say, "Oh, I love what you're working on, but you're a bit early. Can you come back when you have more traction?" What they really mean is like, "Oh my God, I just threw up in my mouth. I'm not giving you any money. I think you're going to fail miserably. But on the
Ah,
off chance I'm wrong, or if you pivot into something good and I
mm.
want to see it again, I don't want you to think that I'm a total asshole. So I'm going to leave the door open a crack." And the frustrating part for a founder is it's very hard to tell the difference between, like,
Yeah,
I'm not interested, but I'm going to claim that you need
I
more
am.
traction, and like I genuinely like what you're doing, and I want you to have more traction. Uh,
Hmm.
and we do it for a couple of reasons. I told you, like, we want to leave the door open in case something changes or in case we're wrong. Sometimes we do it because they tend to be a little conflict avoidant, and they don't
Yeah,
like the bearers of bad news. I mean, not me, I'm a dick, but most people, it bothers them to like give bad news and crush people's dreams.
yeah,
So they end up through, in this case, an abundance of kindness, actually wasting a founder's time.
no.
So
True.
on the one hand, I would love it if I could rally all my fellow venture, people to just, like grow a spine and just say no when you mean no. But I also know that, like, that's not going to happen. So
Yeah.
if you're a founder, here's a couple of things you can do to kind of suss out which kind of no you're getting. Um, okay, so Amy, you just told me you love what I'm doing and you just need a little more traction. I'm like, okay, that's great. I hope you won't mind if I put you on my investor update list. Your answer will invariably be yes, because you can just ignore it. And then I'll say, well, just so I know, I want to be respectful of your time. I don't want to ping you, when I'm still too early. Um, what are you looking for? What's that dividing line between too early and like, okay, now I'm interested? Like, what numbers should I be shooting for? You
Mm-hmm.
leave it a little vague. It could be, dollar amounts, it could be number of customers. It could be the product's finished and it's shipped and you got on.
Okay.
Then it's not a bad, there's a decent chance that they really meant that you were too early. If they hem and haw and like, oh, it kind of depends. Well, there you still don't know, right? Because it could be one of two things. It could be like you're trying to pin me down, and the answer is never. There's no amount of traction, right? You just suck. Or
So then it's a real no. So then you just know,
yeah.
right? That's a
So,
good
but
call.
it could also be that it's actually really hard to come up in many cases because it really depends on a lot of things. So, for instance, if you go from zero to $200,000 ARR in 2 months,
Mhm.
that's more impressive to me than if you went from zero to $500,000 in a year and a half.
Oh, well,
Right. So
yeah.
the slope of the line, it also matters. It's not just how high you are, but like,
Mhm.
how fast you got there. And then there's other things like, well, if you're doing 200,000 ARR and it's really just two big clients, and then I dig in and it turns out one of those clients is because your cousin works at the company and they got you a pilot. That's a heck of a lot less impressive to me than if a company has gotten to the same 200,000 in the same time period, but it's
Mhm.
done it like 5 grand at a time. It's a different product.
Right.
Right? And then they can show me their, what their sales funnel looks like and how they do the sale. Whereas that first company, it's just like I picked up the phone and I called my cousin.
With
So
you.
there really are a lot of legitimate things that matter around what traction is. So if you get someone who says, "Oh, it kind of depends," it's like, well, for a company like mine, you can kind of help them out. Where if my average sale is the 5 grand per customer that I expect it to be, like how many customers would be meaningful for you? Like, when should I call you back? I don't want to waste your time calling you back too soon.
Right.
You can push a little bit. Um, if you can't get any meaningful guidance, even like, oh, it depends, A might work, B might work, but sometimes I need a little bit more, sometimes I need a little bit less. if you can't get anything at all on that one, or it just seems vague and squirrely, it's probably a soft no.
Mm, good to know. That's awesome. Yeah, I have one VC say, Amy, when you get 10 customers, we totally love it. When you get 10 customers, call us back. So
So that
I
was
could,
probably a genuine,
yeah, the genuine
we love
thing,
it.
right?
You need a little bit of more proof points for us.
Yeah. Okay. That's
Yeah.
good.
And
Yeah.
you should keep a little spreadsheet. Like this one said, once I get to X, this one said, once I get to Y.
Yeah.
Some might be like, well, we don't lead. So once you get to 200,000 out of your $1 million raise, then call us, right?
Yeah.
Keep
Yeah.
a spreadsheet like all of their, their conditions.
For sure. Yeah. Which might change, but at least you got something to go off of, right? I
Yeah.
mean, yeah. So that's good. So how when I've heard this too, and this is really kind of interesting for me. And I was a real estate syndicator fund manager. So I get the private equity game, right?
Yeah.
And so what is the difference for most founders you don't understand? What's the difference when you're at the beginning of a raise or when you're at your first close versus when you're at the end of your cycle as a fund? And
Oh, yeah,
your
that's a good one.
criteria that changes over time, right? So
Yeah.
how does that affect how you allocate capital?
So I didn't know this at all when I started, right? I just saw VCs had money and that was the end of it. Uh, and I actually owe a debt to a guy named Jeff Buskang from Flybridge Ventures, who wrote a book called Mastering the VC Game. And it was one of the few books out there in the space that wasn't a 20-page PowerPoint stretched into 300 pages of BS. So I'm going to
Awesome.
give him credit for explaining it to me, even though it's basic facts and you could probably Google it. So the typical VC fund at the early stage, seed, Series A, is a 10-year cycle, right? The fund is getting commitments from LPs or its investors, and it says, you give us your money when we ask for it, and I'll get to what that means. And sometime between now and 10 years from now, we're going to give you back a bunch of money.
Mm,
Now there may be 2 1-year extensions, like, oh, the economy's bad, the exit windows are closed, we're going to extend it to 11 or 12 years, but usually that's the time frame. And to make that work, though, a fund can't be making new investments right up until the end, right? So I want to invest in Amy's company. Amy, your company, it's going to be at least 6, 7, 8 years before you exit.
mhm.
So what that means is I can't make new investments outside of the first 3 years because I give you time to grow. So
Right.
usually the first 3 years is the initial investment period. And then I might still make some investments in years 4, 5, and 6, but those would only be in existing companies as they follow on. Right? I might say, that's great, Amy, you're raising another round, it's up round, I'm in, I want to participate because I want to double down on my winners.
Mm,
But even there, once you start getting to the end of that 6 year, it's really tough to justify putting more money down.
mm,
And by then you're usually tapped out and it's a waiting game.
yeah.
You're waiting for your companies to mature and exit, and then you can start distributing money to your LPs. Now, if you're doing it right as a VC and you're doing it well and your investors want to keep playing with you, you'll raise a series of overlapping funds. So like fund one is when the fund one's 3 year investment period ends, you've got fund two starting up. So
Mhm,
you'll do follow-ons in the existing fund one portfolio companies out of fund one, but then new companies, when you invest, it'll come out of fund two. Now, to the entrepreneurs, it's just, XYZ Ventures,
mhm.
but the check comes from XYZ Ventures Fund One or XYZ Ventures plus two.
Right.
So if you're a founder and you feel like, you know, I don't know, this guy have money or not, your question is like, hey, I'm just curious, what fund are you investing out of? And they'll tell you like, oh, whatever it is, XYZ Ventures 3. Oh, awesome. When did you close the fund? You're asking. If they tell you, oh, we closed the fund over, and it's over 2 years ago, or even close to 2 years ago, it's fair to ask them, oh, so are you still making new investments out of the fund? Or how much dry powder do you have for new investments?
Mm,
Because if they've already been doing it for 3 years, then they don't really have anything to give you.
right.
So you don't understand that. It is unfortunate but it's true that some VC funds will continue to talk to startups even when they don't have dry powder because they're afraid if it looks like they're not in the market, people will forget about them,
Hmm.
and to be a little bit charitable. In some cases, they think they're close to closing the next fund anyway, and
Yeah.
they want to know, like, all those companies that are, promising but not quite there yet. They need to be talking to them now so that in 3 months, when their fund's in place and the startup is ready, they're ready to pull the trigger.
Yeah.
But they should be open to you. And if there's over 3 years, like, yeah, but we're raising our next fund and we expect to do a first close, whenever.
Mhm.
Right. So that's an interesting qualification question to ask. I wouldn't be the first thing out of your mouth. It's like
No.
going on a date and asking how many kids do you want. Like, can we work our way up to it? But it's a fair question to ask.
Yeah, yeah, for sure. So, if if I'm a founder, I looked at your profile, I recognize that you are investing in prop tech, and it doesn't really tell me whether you're early stage or,
Oh,
late
mine does.
stage. Oh, yours does?
It
Okay.
says it right there.
Oh, well, look at that. All
Yeah.
right. So if I'm your candidate and
Oh,
then
by the
I
way, and
reach out,
if it doesn't,
yeah.
the best thing you could do is, if it's a fund, go on Crunchbase or PitchBook or whatever you have access to, look up the company and see where they invest. And most
Mm,
importantly, see where their first investments in companies tend to be. But you might find, oh, they invested in the Series C, but if you look back, 2, 3 years, like, oh, and they invested in the B and the A.
no, okay.
Right, so
All
you're looking for where the earliest points of entry that fund are. So if you look at the fund, and the earliest they come in is generally the Series A, with very few exceptions, and you're a seed stage company, you're probably too early for them just in general.
right.
Not because you're too early, just because they don't invest that early, period. So if you're not sure, Crunchbase, that's probably a good source to go to.
Well, does anybody ever change their mandate? Do they
Yeah,
start investing in early stage if they've been routinely A? I mean,
yeah, no. So Dream It did just that. Like, originally, we were pre-revenue, pre-seed companies, and then we
Mhm.
moved to be post-revenue, often pre-Series A.
Yeah.
We did it very consciously. And the hard part for us back then was, if you use the word accelerator, everyone just assumed that meant, oh, pre-revenue. And they're like, oh, we're too far along for you. And I'm like, no, you're exactly where we want to be, because we're not doing that anymore.
Mm.
So we changed our website. We stopped using the A word, and it was challenging for us. Look up the investor. Like, if they're a VC, it should say what they invest in right on their website.
Hmm.
They should be very much upfront with it, or on their LinkedIn profile, or anywhere else they go out to market.
Hmm.
And if they're not, just go by what their more recent investments are.
Hmm.
And if it looks like they do seed and you are a seed company, it looks like they do your industry, and reach out to them. If it's changed, at the very least, they'll be like, well, okay, I mean, that was totally reasonable. We just don't do that.
Yeah. So, what do you like to get in your first email when someone's like sending you stuff? What do you like to receive?
You know, Bitcoin.
Yeah, I know, right?
No,
Right,
no,
right.
no.
Okay.
So first of all, I want my first email to come from somebody that I know, right?
Okay.
Like most VCs, getting a warm intro is a great filter for us.
Mm.
And we're pretty tightly connected. So if you can't get a warm intro to us, it raises some questions about your ability to get warm intros to, say, customers
Yeah.
or other partners.
Okay. Okay.
So
That's a
think,
good
think of it
answer.
as you passed your first test if you've gotten a warm intro to us.
Hmm.
Um, I want a short email, like super short, but that
Hmm.
tells me what you actually do. Like,
Okay.
people have reached out to me on LinkedIn, and I'm like, oh, we got this great startup. Call me, I'll tell you about it. I'm like, no, no. If you
No.
can't, if you can't be bothered to write a sentence or two, tell me what you do. I'm not interested. And then I get one this big, and I'm like, no, no. Yeah, I'm not giving away that much of my attention up front. You have
Yeah,
10 seconds of my attention. Give
exactly.
me something that tells me it's worth my time, right? This is not like, one of those like mystery pitches where it's like, oh, would you invest in a company that's gotten to $1 million ARR in 6 months? Yeah, sure, maybe. Oh, but we're in the ad tech space. No. Would it kill you to just say you're in the ad tech space up front?
Exactly. Wouldn't
He's
it
like,
be?
well, I wanted you to get excited. I'm like, no, you wanted me to say no after I wasted more of my
Wanted
time.
to bait and switch me.
It doesn't really matter. It's like, if you're not upfront about it, it's not like I'm suddenly going to get so in love with it that I start investing in stuff that I don't invest in.
Mm,
Right? I mean, that's what my mandate is. Now it's a little different with generalists because their mandate is whatever, sure.
yeah.
But if somebody has a sector focus or a theme focus and they're clear about it,
Hmm.
I'll let you do, right? You're saving everybody time. So I
Yeah.
would really love, and this is what I just I do this session a lot for other accelerator programs. I was at Metaprop yesterday with their new class, really interesting companies.
Hmm.
And they asked me to give a session called How to Prospect for Investors.
Hmm.
So how do you identify the investors that are relevant to you? How do
Hmm.
you get warm intros to them? And at the end, I talked to them about what their warm intro email should be. And this is what I want it to be. So let's say um, one of your friends, Amy, is raising money for a construction tech startup, and they've identified me as a construction tech investor. Check. In the early stage, check. And they notice that you're a mutual connection. Oh, by the way, we should make sure we're linked when we're done.
Yeah.
So they realize that you're a mutual connection, and they're going to ask for a warm intro. That's 3 checks. Great. So they should send you an email that you could just boom hit forward with like maybe a line of topspin. But their email should be something like this: subject line: Company X would like to meet Andrew Ackerman, or insert fund name there.
Hmm.
Subject. Sorry, that was subject. Body: Hey, Amy, as you know, startup name here does A, B, and C.
Okay.
I see that you're connected to Andrew Ackerman on LinkedIn. I also see that he's invested in example company A, example company B, example company C. So I think he might be interested in my company name here. Do you know Andrew well enough to make an intro?
Mm,
I would like to see is the forward from you where you go, Amy, you're sending it to me, and it says, Andrew, I really love these guys. Details below. Do you want an intro?
there you go.
That's what I'd like to see. And
Okay.
I'll dissect it just a little bit in like I don't know how much time we have left, but like subject line, it won't go, I hate it like when it's just intro. I get a lot of that crap. I want to be able to see it in my subject line, what it is,
Yeah. Yeah.
who's reaching out to me.
Yeah.
Uh, Number two, I want a clear and concise description of the company, because then I
Mm,
know right away if I'm doing it. And as a founder, you should write that, not rely on the connector to do it, because you know your company better. And it's
yeah.
just easier, right?
Yeah.
If your friend had come to you and say, hey, me, Andrew, can you tell me about my company? You would then be forced to write the email describing their company,
Right.
which takes more effort. And you won't do it as well, just because, not your business. I like he's invested in A, B, and C, therefore he might be interested in mine, because A, it shows me that they've done their homework, and B, I can make a judgment like, oh yeah, that's right, it is kind of similar that way. It's actually more helpful for you, Amy, in that circumstance, because you might not know my thesis in and out, but if your friend has just spelled it out and says, oh, he invested in these, I'm like these, but oh yeah, that makes sense. Right. So it makes it easier for you to be comfortable to make that warm intro for your friend, for the founder.
Mm,
And then that last piece, do you know Andrew well enough to make an intro? There's inherently an easy out there. Right.
yeah.
So let's say, for whatever reason, Amy, you're not really sold on your friend's company. And you don't want to,
Like ruin my reputation by
so
making the intro.
what you might do is you might just sit on it. Oh, I got lost in my inbox, hoping that your friend is so disorganized that they'll never ask you for it again. Oh, I never saw that email, right?
Mhm.
Or if they ask you whatever happened, you dig it. Oh man, I totally forgot about that. That was months ago. Sorry,
Oh.
missed it. Do you still need that intro? No, our company's bankrupt. Um, so
That's
if
funny.
if the founder is on top of it and says,
Yeah.
"Hey, I haven't heard back from you. It's been a week. Have you heard back from Andrew?" Right? And it may be that you've already reached out to me and you're waiting to hear from me. It may be I've actually already responded to you and it's sitting in your inbox. You just haven't seen it yet. So that's a good reminder.
Mm-hmm.
The other thing that it'll do is you'll always, oh damn, friend's not gonna let this one go. Oh, but they asked me if I know Andrew well enough to make an intro. Like, oh, and I just interviewed him once on the podcast. I haven't really spoken to him in 2 years. If there's anybody that you're more tightly connected to him, you should probably go for that. That would be a better intro. So you have a very nice way, without saying your baby is ugly. I just don't think I can make that intro.
Yeah, exactly. That's interesting
And
for
as
sure.
far as the founder is concerned, if you're not going to make the intro, they want to know that so they can ask somebody else. They want
Yeah.
to go through a quick yes and no. So you got to give them that out. So that is the slightly expanded version of what I would want to see in my inbox.
Mhm.
Uh, that would lead me to like, oh, I'm going to follow up on the startup.
Let me ask you about your thesis. Do you ever feel like you get oversaturated in one type of investment and therefore you stop investing in it? You know what I
So
mean? Like,
I
it's like,
definitely, so first of all, I'll only invest in one company that's solving that particular problem, right? So
okay.
there's a portfolio conflict's a big deal for us, right? We never want to have, with rare exceptions, we never want to have two companies that are going to the bed, head to head with each other.
Okay.
And there's all sorts of conflict of interest if we do that. Plus, also we're betting against ourselves if we do that.
Yeah, true.
So it's not really the way to go. So if I see a company that's like coming in my portfolio before they tell me anything, I mean, listen, I'm already invested in this company. Are you conflicted with them? Are they your direct competitor? And the acid test there is usually if company A has sold to a customer and company B tries to sell to them, if the customer's like, oh, I already use this for that, there's no reason for me to pay twice, they're a competitor. If they're like, oh, I use this company for that, but oh, I could use this for something else, and they might pay twice, then you're okay,
Okay.
regardless if down the road one company may move into the other company's space.
Yeah.
So, um, do I ever get saturated? It doesn't work that way. Like I may pick a horse, and that's my horse. But
Okay.
sometimes, like in certain spaces, I just don't know enough to know which horse I want to bet on. So, like modular construction,
Mm,
they, and this is a little played at this point, but when they were first coming out, it was like a same but different sense to them.
mhm,
They were all of them kind of felt the same way. And
mhm.
unless you dug really, really deep into the actual and the engineering of the matter, it was hard to have a thesis like this one's better than that one. And even
Right.
if they did, they weren't that different. But the differences were subtle. And what was gonna make one horse win and another not? It probably come down to a little bit of luck and the founding team, like who's really good at those kind of sales.
Mhm,
Uh, and I just couldn't find, the years I was looking at, I just couldn't find any one company where I'm like, that's the one. Like I know
mhm,
one of these six are going to win probably. I just don't know which one.
mhm.
And in that case, I just didn't place a bet.
Yeah, I'm with you. I'm seeing that they're failing anyway. I just saw a modular construction,
Yeah.
but it was in the UK because Europe, that's like if you want to see what's gonna, I did not realize this, but Europe is so far ahead in prop tech compared to the US and
Parts of prop tech.
parts of prop tech they are.
Certainly, it definitely had a leg up on anything that was on the environmental side.
Yeah, for sure.
Um, but yeah, there's certain areas where they're ahead. There's certain areas where Asia is ahead of us in some ways.
Yeah.
Like a lot of the construction companies are vertically integrated, or a lot of the real estate developers are vertically integrated. So adoption of some of that technology has been faster,
Hmm.
there than it has been here.
Yeah. So do you scout? Do you have like a big prop tech scouting arm, like looking for, is that the secret sauce? Am I giving away, are you giving away secrets?
No, it's not secret sauce. Like
All right.
the
Okay.
dirty little secret is that most VCs are exactly the same. They just have different logos, right? We wouldn't accept that from our portfolio companies, but then we do all of that. Yeah, I know we're horrible. We're hypocrites. Um, no, so my approach to VC has always been I want a platform to base it on. And I
Mm,
wrote this in LinkedIn a little while ago. And again, remember, this is August 2024. So I think I wrote this just late 2023 about truly differentiated VCs. What kind of strategies are there? So there's a couple. Like number one, oh, I'm Andreessen Horowitz, right? Oh, so I'm like the best, right? You're one of like the top firms. Like, okay, then a startup wants you on the cap table because, oh my God, I got Andreessen on my cap table, right? But the problem with that strategy is like if you're not Andreessen, you're not Andreessen. So it doesn't really help you. Right now, if you're coming into a new industry
mm,
and you could be like the number one in that industry. Okay, that's potentially an avenue for you,
Right.
but no, that's not really for everybody. Corporate VC is another potential platform. Most people screw it up really, really badly, but in
Yeah.
theory, like I got this like multi-billion-dollar company behind me, and I can get you tons of customers. And by the way, if you've got, me as a customer, like if you got related as a customer, that's a brand name
Right.
that you can like take to the bank, meaning to the VCs and stuff.
Yeah.
So, there's a potential there. Again, it's usually executed poorly. And then
Hmm.
you get a couple of others, like Dream It was a later stage accelerator program experience. So like a VC would say, oh, I can make tons of introductions, really smart guy, did a couple of exits, and we're like, okay, we do 2 weeks of customer sprints where we put you in front of a dozen or two potential customers who have all selected you, so they're pre-qualified. Well, okay, well, that's obviously indifferent. Like I can make a lot of introductions versus 2 weeks face to face, curated, pre-qualified. Oh, I get the difference. I got right. That's what I mean by being differentiated or like a
Yeah.
platform that's really advantaged.
Yeah.
And I'm working on something now that's it's not yet public, so I can't talk about it. But that's my next version.
Yeah.
But the guys at Second Century Ventures run a program that was actually in some ways similar to what Dream used to do, right?
Hmm.
They're very, they're a little stage agnostic, so they'll go up to like a Series B, even a Series C company in some cases,
Interesting.
and they have access to, the entire $1.5 million, 1.5 million member NAR, National Association of Realtor organization, so they can make introductions to like Miami Realtors, 40,000 members, right?
Hmm.
Make those introductions. They can get companies in front if that matters to them. And they also have contacts on the commercial side. So it is, their platform is fundamentally advantaged in a lot of ways.
Yeah.
There's a lot of different ways to like skin that skin what? I don't even forgot what that expression is. Skin something. Skin that
Yeah.
cat.
It's some animal
The
and yeah,
cat. It's always a cat.
it's always,
Um, there's a
yeah.
lot of different ways to skin that cat,
Mm.
but there are very, very few VCs that actually have anything that makes them different from the guys right down the street.
Yeah. So do you care if a startup's been through an accelerator or not? I've kind of avoided them because I didn't want to hang out with a bunch of 20 and 30-year-olds and I'm older and I'm like, I'm not
Well, in
really.
my program, most of the people are in their mid-30s, plus or minus. With
Yeah.
some people going, there was one guy in one of my programs who was in his early 50s.
Yeah.
So a lot depends. And this is the thing. I also teach a course on entrepreneurship, and like the students have grown to like to flinch every time I say it depends.
Mm.
So it depends on which one, right? So some of the best accelerators or the accelerators in the right industries can be signaling factors.
Mm.
Great, that's awesome. It helps. And if the accelerator is any good, they've whipped some of the like the stupider mistakes out of you. Right?
Yeah.
Pitch deck's probably going to be better than the average.
Mm-hmm.
Maybe your idea is a little bit better, unless for certain accelerators, I'll look at them like, okay, it's been vetted, right?
Okay.
The
All right.
bottom 30% of the startups that make me throw up in my mouth, probably not one of them. Unless it's like that accelerator, I've never even heard of that accelerator, in which case, yeah, no signal.
Yeah.
Um, so I would say the right accelerator is actually a positive signal. Any other accelerator is totally neutral to me.
Okay.
I don't weigh it at all.
Okay.
But it's only a mild positive, by the way, because I know as you may or may not have noticed, I have strong opinions.
Yeah. Just a
And
little.
just because a company's gone through Y Combinator doesn't mean I think it's any good.
Okay. All right. Yeah, we'll have to get your list of what ones you think are worth it or not. I look, I really avoided them like it. Well, partly because I came from real estate. I knew what the product needed to be. I had product market fit. You didn't have to tell me how to do product market fit. I knew what it needed to be. I tried it out on my properties and therefore it works. And now we're just, you're sending out to the
Yeah.
masses to the other people. But
So I
so but
wouldn't
it
do a
was like,
generalist program if I were you.
yeah,
Like an industry program that's really, really good, is almost always trumps a generalist program for a couple of reasons. One is you get an MD, as our managing director, who's like in his or her mid-20s, never worked in real estate. Like, how much can they really help you?
Yeah.
We already got all these advisors and mentors. Yeah, when you need them, some show up. A lot of them are just like, oh, I put my name on that wall like 5 years ago.
Hmm.
Um, so the generalist program generally not, and also on the customer side, right? If you're a real estate focused program, you're going to have a deeper network of potential customers than a generalist that needs to have a network across 30
Yeah.
different
All
industries.
together. Yeah, for sure.
But then, it might be worth it. Might be worth it. Depends on how much time they want, depends on how much equity they want. It depends.
Yeah.
Do you love
No,
that
thanks.
phrase?
Thanks. Thanks for that. I appreciate it. Well, this has been so much fun. This has been a really cool conversation. I'm glad you signed up for my show.
Oh,
It's
my
been so
pleasure.
awesome for sure. It's been really, really cool. Well, if somebody did want to email you, the exact email that you would want to receive,
Sure,
where
sure.
they
So
get a
if it's at all prop tech related, send it to my Second Century Ventures email
Mhm.
address, which should be my last name, Ackerman, Ackerman at SCV, Second Century Ventures.vc.
Okay, very cool. Well, thanks for coming on my show today.
My
It's
pleasure.
been so
My pleasure.
awesome.
Have a great one.
All right, we'll see.